Bad debt. Bad debt. Debtors. Assume that we have a debtors balance of rupees 10,000 and we have a doubt, are we able to get the entire amount without any hiccup or shall we face any default? If we face any default, how can we handle the default? The default of recovery of any amount from the debtors is named as bad debt. Out of the 10,000 rupees, it is assumed that rupees 500 could not be recoverable, then that will be named as bad debt. That will be named as bad debt. I hope so you could not understand. Bad debt is a loss or expenses and nominal account. And debtors is a personal account. Debtors is a personal account. So whenever there's an expenses that should be debited, as here bad debt is a loss, it should be debited. So bad debt account debit, bad debt account debit, and to debtors. If you are spending the money, then the entry will be expenses to cash. But if you don't spend the money, then it's outstanding, then expenses to outstanding expenses. That's how you can pass here bad debt. Also, a loss here, so bad debt is debited, and of course, cash has not gone out, but it decreases the asset. Cash gone out means that cash asset is decreasing. Here, cash is not decreasing. Instead of that, debtors balance is decreasing. That's why I'm going to credit the debtors. This is similar to depreciation. Whenever any expenses arises, expenses or loss arises, automatically you have to keep that in your mind that this leads to a loss, so it should be debited as per the nominal account rule. And it reduces the value of the asset. The value of the asset could be predominantly cash. If it is not so, sometimes it may be some other assets. In the case of depreciation, because of the usage, the assets value could go down. So that depreciation is named as loss and expenses debited to the P&L account. It reduces the value of the assets. The same way, the amount not recovered, the amount not recovered is named as debtors, bad debt. That bad debt loss is debited and it reduces the amount recoverable from the debtors by 500. After passing this journal entry, you are pretty sure that the amount recoverable from the debtors is only 9,500, not 10,000 rupees. Is it clear? And of course, in the year end, while preparing the final accounts, that bad debt should be transferable to the P&L account debit side. So for that, the journal entry will be profit and loss account debit, profit and loss account debit, and to bad debt. That's how you can pass the journal entry. Is it clear? This is the first part. This is the first part. The next part I'm going to discuss here is, as we are aware about there will be bad debt in the future, we have to be double cautious and we have to get ready to face or adjust the losses if it arises in the future. Rather than directly debiting to the P&L account, we can create a provision by charging the P&L account whenever the bad debt arises. Then that bad debt could be adjusted in the provisions already we have created. So, assume that for the creation of provision, that model. So, PDD, provision for doubtful debts, or sometime it may be named as reserve for doubtful debts. Provision for doubtful debts is created. How I'm going to create here? The creation of the provision for doubtful debts is nothing but we have to take it from the profit and loss account only. Profit and loss account is the main source for adjusting all the expenses. Similarly, bad debt expected not now in the future. Bad debt expected not now in the future. As we have expected that bad debt in the future, we can keep some money aside. Similarly, just what happens in your real life, you are keeping away some of your salary for your future benefits like education and for purchasing some assets or for your retirement life. You may get a regular pension, it may safeguard your retirement life. So for all these purposes, you can keep some money out of your salary aside and invest it. See, whenever the expenses comes, it can be adjusted in the P&L account. Here, the P&L account is similar to the salary check, salary paycheck. Like all of your monthly commitment could be met out of the salary, and you may plan that out of the salary what you have, a small portion could be set aside to meet the academical expenses or education fee expenses. Usually, it happens during the academic year beginning for payment of education purpose. Or one of my friends usually keeps some amount away out of the salary. He accumulates all this amount the year long, the year end, the December usually. Out of the accumulated amount, he spends for his recreation purpose like touring or whatever it may be. You might have heard about the Diwali fund. Some money could be kept aside out of each and every month's salary. And when the Diwali celebration comes, you can, without any financial trouble, can spend the money out of the amount you set aside in the name of Diwali fund. Similarly, when you are selling the amount means goods in credit, of course, debtors are debit to sales, and we are aware about that the entire money may not be recoverable. There's a chances of losing some amount because of non-recovery or default. That default is named as debtor, which is bad debt. Of course, suddenly any loss arises, a bad debt can be met out of our own salary paycheck. Here, salary paycheck is named as profit or loss account. So that bad debt loss can be adjusted to the P&L, but you are aware about somehow a portion may be lost because of the bad debt. Why don't you keep some amount away so that meeting the losses out of this amount kept aside, so you don't find any pain, right? Such way, here I'm going to keep the money away from debiting from the P&L account to profit provision for doubtful debts account. Is it clear? I assumed that to that extent of 500 rupees could be lost in the future. So ahead, anyhow, Diwali will come and year end will come and the tour will come, education fee will come and retirement will come. And after that, you have to meet so much of expected expenses, as these expenses are expected during your working age. Out of the regular paycheck, you are keeping the money away. Similarly, here the salary, like here we have is the okay salary, like we have the profit and loss account. So the profit and loss account is the main source of income for the business people, and rather than meeting that expenses as and when it arises, we'll keep a some amount away for meeting the bad debt loss, which is called provision for doubtful debts. This is called specific reserve. Specific reserve means it has a specific purpose. The PDD can be adjusted out of the it can be used for adjusting the bad debt only. So we have kept aside ahead, and for the year end we came to know there's a bad debt. So the bad debt will be say rupees 500. So the journal entry for the bad debt is bad debt account debit to debtors. We pass this entry. Is it clear? Okay, 500 rupees. And what happens now? The bad debt usually will debit to the paid account, monthly paycheck, but we don't debit that in our monthly paycheck because an amount kept aside to meet the bad debt in the name of PDD. So rather than the bad debt adjusted in the P&L account, I'm going to adjust in the PDD. Further, the journal entry is the amount available in the credit side of the PDD is now used by debiting it. PDD account debit 500 rupees and to bad debt. Okay, so these are the two models you have to understand. These are the two models. Clear? Now this is these are the two entries we can pass when we don't have PDD. When we have no PDD. If we have PDD here, PDD model for the creation of the bad debt, sorry, provision for doubtful debts, and at the time of adjustment of bad debt, okay, at the time of real bad debt, and adjusting the bad debt in PDD. These are the three sets of journal entry you have to understand. Clear? Come on. I'm going to explain these two in detail with the two illustration, and I'm going to incorporate that in the main illustration. Finish of copying this, I will proceed further. Make it faster. After copying, text me once it's over. I'll let us around 10,000. I will explain all these concepts in detail. And bad debt around 500 rupees. Provision for doubtful debts. Provision for doubtful debts. 400 rupees. These are the items available in the trial balance. Apart from that, the items available in adjustments are listed here. Items available in the adjustment. Number one, bad debt. Bad debt rupees 500. Two, provision for doubtful debts. Provision for doubtful debts. 10%. Now we have to pass a journal entry for all these things. Let me brief all the points first of all. What does it mean? Okay. Okay. Let's see here. Debtors is the balance amount recoverable from the buyer of our commodity. Provision for doubtful debts given in the trial balance is nothing but opening provision available. This is nothing but opening balance, OB. In the previous year itself, we have created the 400 rupees, considering there will be bad debt loss the later, so that the bad debt could be adjusted to the 400. So this 400, the 400 appearing in the trial balance is nothing but opening PDD, opening balance to be adjusted for, used for adjusting the bad debt. And here is bad debt. If the bad debt appears in the trial balance, it means the bad debt first journal entry. We have to pass two journal entry. Journal entry number one is bad debt to debtors. Next one is that bad debt will be adjusted either in P&L account or in PDD. If we don't have the PDD, that will be adjusted in the P&L account. So from the debtors, we transfer to bad debt account, and that bad debt account can be later adjusted to the P&L account or can be adjusted to the PDD account. If we have the PDD, we can adjust it. Now, when the bad debt comes in the trial balance, it means the first transaction is passed. What? Bad debt to debtors journal entry is passed. Okay. Here, I just keep this as A point. Now, bad debt given in the adjustment, what does it mean? Even the first journal entry, debtors to bad debt entry is not passed. It's not passed. So it means you have to pass this first entry. What first entry? Bad debt to debtors entry should be passed for this, as well as adjusting the bad debt to the P&L account will also be passed. Okay. And then the PDD given in the adjustment representing the provision is supposed to create for meeting the bad debt loss in the forthcoming year, for the future. For the future. I myself name this as being the PDD given in the adjustment, otherwise new one, and bad debt given in the adjustment as the new one, and the bad debt given in the trial balance and PDD given in the trial balance. Is it okay? You keep all these right. You should not have any confusions. You should not have any confusions. Right. Now I'll give you two working notes. I will give you two working notes. Working note number one, how the amounts are going to be appearing in the balance sheet. The debtors here being 10,000 rupees as per the trial balance. As per the trial balance. Minus out of that bad debt should be subtracted. Which bad debt? Which bad debt? Come on, tell me, can you guess me? Which bad debt? So I have been given two bad debt here. Number one is this one, number two is this one. One bad debt is in the trial balance, another bad debt in the adjustment. Come on, tell me which bad debt will have the value for subtracting from the debtors. Come on, can you guess me? Come on, come on. Yes, or both. Either 500 in the trial balance or 500 in the adjustment or both. Which one? Okay. I don't know why you are silent. I'll write here the bad debt given in the adjustment. The bad debt given in the adjustment. Why, sir? Why, sir? If the bad debt given in the trial balance means already the first journal entry, bad debt to debtors is posted. Because of posting that journal entry, passing the journal entry, the data is already adjusted to this extent of bandit. Is it okay? So as I already told you, this one, for this one, this particular entry is passed. This particular entry means that data amount reduced and transferred to the bandit is over. But for this, the entry is not passed. So you have to subtract only the bandit you expected in the forthcoming year or just now expected after the preparation of the trial balance. Otherwise, it requires the adjustment. So 9,500 is the balance amount we are sure will be recoverable in the later period. Okay, clear? Okay. Is the words clear from how many is it the problem for you all or for one of two? Now, is it audible? Clear? Come on. Yes. Yes. Now, so here the bad debt given in the trial balance will not be adjusted in the first case because this is already deducted from the debtors. We mind only the bad debt given in the adjustment. So it is going to be subtracted. So the 9,500 we are pretty sure somehow will be receiving this. From the 9,500 we assume some portion may become bad. From the previous year's experience to the extent of bad debt out of the total debtors could be calculated. Out of 1 lakh, around 5,000 may be lost, around 3,000 may be bad debt. So for the 1 lakh, if it is 3,000 one time, 5,000 one time, 6,000 one time, you can take the average of those things around 5 or 6%. Usually, provision for doubtful debts is a means estimation, may not be real one, may not be a real one. Is it clear? As it's only a real one, not real one, it's only estimation. So most of the time it may be given as a percentage. Most of the time it may be given as a percentage. Is it okay? 10%. So I'm going to find out the provision for doubtful debts from here. Provision for doubtful debts from here, which is given in the adjustment. So what about the trial balance, sir? Trial balance, that PDD given the trial balance is nothing but amount available for adjusting the bad debt in this current year created in the previous year. It's having no botheration for the current year. So that may be roughly around 950 rupees. 950 rupees we can create this. These two will be appearing in the balance sheet. So this is nothing but debtors appearing in the balance sheet. Debtors in the balance sheet. And this will be, the PDD may be appearing in the asset side as a subtraction value from the debtors, or it can be shown in the liability side. Both the way it can be shown. Is it okay? This is the working note number 1. Now I'm moving on to the working note number 2. In the working note number 2, how far it is going to be treated as an adjustments by transferring to the P&L account is going to be discussed here. Is it okay? Now, working note number 2. Now, bad debt supposed to be transferable to the P&L account. I mean, adjusted in the PDD account. So we already have the bad debt in the trial balance. Bad debt in the trial balance is already recorded by subtracting the debtors account. Means the entry for first part, bad debt to debtors is passed. Bad debt to debtors is already passed. But the second entry, that should be either adjusted in the P&L account or PDD is pending. So I'm going to take that one, which is nothing but the amount available as a bad debt in the adjustment, which is 500. And then next bad debt is here, which is a new one. This is also bad debt. This is adjusted one. Okay, this bad debt is nothing but given in the trial balance, right? Supposed to be adjusted, and it is a new one supposed to be adjusted here, which is 500 rupees. Bad debt given in the adjustment. So the total bad debt came around rupees 1,000 rupees. Is it okay? So for adjusting the loss, do I have any PDD created in the previous year? Of course, sir, I have around 400 rupees already created in the previous year. It means after the 400 rupees, what happened? 600 rupees shortage is there. Still there is a shortage, means to the extent of amount available in PDD can be adjusted. Here we have only 400 rupees and shortage is 600. That can be directly debited to the P&L account. Is it clear? This is the simple logic that you can keep in your mind. Apart from that, for the next year also you have to create the fresh PDD, which is 950. So how much is required here? 1000 rupees is required, but we have how much already in the PDD account in the trial balance created in the previous year? Okay, trial balance we have around 400 rupees. 600 rupees shortage is there. 600 rupees shortage is there. And for the next year also I have to, this amount is debited to the P&L account. This amount is debited to P&L account. Not only this, the future, for the forthcoming year we expected another loss. For that another 950 is supposed to be created. This should also be debited to the P&L account. So both the value will be debited in the P&L account. So the ultimate amount to be debited in the P&L account is 1550. Is it okay? Now I am going to pass the journal entry. I hope so you could now understand the entire set. I am going to pass the journal entry here. Now journal entry will be passed for the bad debt and creation of PDD. Now for the bad debt, the journal entry will be, let me pass here. Bad debt account debit to debtors. Bad debt account debit to debtors. Okay, this is for the new one only. Bad debt account debit to debtors for the new one, 500 rupees. 500 rupees. Right. And then the bad debt completely, how much bad debt we have? Newly created, existing 500. The journal entry for this already passed 1000. And these 1000 rupees will be now somehow adjusted in the PDD only. I am going to adjust that in the PDD. So for adjusting that in the PDD, the entry will be PDD account debit. PDD account debit. PDD is nothing but the amount available in the trial balance. This is the opening balance. This is the opening balance. Is it okay? Trial balance. The amount available in the trial balance. The amount available in the trial balance is only how much? 400 rupees. But the bad debt is how much? Bad debt is 1000. Out of the 1500 rupees is already first entry is passed. That 500 and another adjustment, the bad debt given in the adjustment, so we have to pass another entry. So 500 plus 500, 1000 rupees is the loss. For meeting the current year's bad debt, earlier year we had 400 rupees as our gain. Right. As our gain, or to adjust this specific account. Then we have a shortage. That shortage will be adjusted in the P&L account. Okay. So the first preference of the bad debt to be adjusted goes to the PDD account. If the PDD is not sufficient enough, then we can adjust the P&L account. Not only that, for the next period, you are supposed to create how much? Another 950. For the creation of the PDD for the next year, the journal entry is P&L account debit to PDD. I can club these two journal entries here. I can club these two entries like this. So, to PDD. This is nothing but PDD for the next year. Otherwise, PDD given in the adjustment, which is nothing but 950. So the amount debited in the P&L account is 600 plus 950 both put together 1550. Okay, in most of the cases, no. Here we have the PDD in the debit side as well as PDD in the adjustments, means credit side. They will neutralize these two and net amount like they can pass. This way also it may be accepted. Is it clear? I hope so you could now understand. So that is the another way you can pass. Okay. Now I have passed the journal entry here in detail. Come on, copy this. If you have any doubt, you can post the message here. Now, provision for doubtful debts created here on the good debt. Now listen, this is not good debt. This is not good always. This is confirmed bad. It will not come. Out of the 9500, we estimated some portion may be bad. Is it okay? What is the estimation? So, the estimation could be based on the previous year's experiences. In the previous year, we thought around out of 10,000 rupees debtors, 1,000 rupees lost, or the 1,000 rupees not recovered because of the bad debt. Sometimes it may be 500, sometimes it may be 1,500. And as per these observation, we came to know closer to 10 percentage we may face loss. Similarly, we have 9,500 rupees as the balance in the debtors. We consider that 9,500 will fetch some bad debt. I'm not assuring it may be the real. It may be varying. So I'll just estimate there will be a possibilities of loss. So it's only estimation, as I already told you. Okay. As already told you, for the Diwali, you can keep away some amount for the medical expenses, for the retirement benefits, whatever it may be. But the amount you kept aside is not exact amount, but you are really aware about there have been expenses. But you are not aware about that exact amount. So you just see, I have kept aside 400 rupees previous year, considering in the trial balance, 400 rupees kept aside. Considering in the previous year experiences, I may have a bad debt of 1,000, so 400 rupees. But the actual bad debt is 500 plus 500, 1,000 rupees happen. The actual may be different, it's only a provision. If the bad debt doesn't arises, very happy, you can keep it in your pocket, no problem. But if it arises, you can meet out of that. You can meet out of that. Is it clear? I think so. You can easily have this idea. Sometimes what happens now, the way of recording may be pretty different. The bad debt. For this, the journal entry is very simple. I'll pass the other way also. Sometime some text will give this way. Bad debt account debit to debtor. To debtor. Okay. The value being 500, 500. 500 and 500. And the entire value 600 and 950 both will be created by debiting the P&L account. So here profit and loss account debit to PDD. So we don't mean this is being opening, this is being closing. We will create the PDD, which is nothing but summation of these two values, 1,550, 1,550. After that, the bad debt is blindly adjusted in the PDD only. So the journal entry will be, I am debiting the PDD account and crediting the bad debt. This is the another way. This is the another way. Value being 1,000. The bad debt being 1,000. How the 1,000 comes? Already 500 rupees appearing in the trial balance. Another 500 rupees given in the adjustment. So 1,000. Now find out the PDD balance here. The PDD balance always you cross check. In the opening we have 400 rupees. Further we have created 1,550. Opening we have 400 rupees. Further we have created 1,550. Opening 400, 1,550 created. But out of that, 1,000 rupees is used for adjusting the bad debt class. After adjusting this, we still have 950. That 950 is nothing but PDD meant for adjusting the bad debt in the future period. This balance will exist. This is another way of passing entry. This is the another way of passing entry. Okay. Now I am going to discuss the passing the ledger here. How do we pass a ledger? I am going to follow these journal entries for posting the ledger accounts. What are the ledger account I am going to post here? Listen here very carefully. First of all, debtors account. I will open the debtors account, PDD bad debt account and PDD account and then P&L account all. So when I open the debtors account, this is debtors account number 1. Second ledger bad debt account, and the third one is provision for doubtful debts account. So I have opened all the 3 accounts so to make you understand this one better. I am going to keep these journal entries as the base for posting purpose. Here the debtors being 10,000 rupees. Being in the debit side, I have to post the value in the debit side also. Debit side itself, so balance. The amount available in the debtors is 10,000. And this is over. bad debt given in the trial balance, it means already the balance exists. So to balance 500 rupees, 500 rupees. And then the PDD, opening balance, credit side appears. Anything appearing in the trial balance can be opened the concerned ledger account and post the same side. If it is in the credit side, you post in the same credit side. So by balance, balance being 400. Is it okay? And for the adjustments and rest, I have passed the journal entry. I am going to post this bad debt. Two debtors. In bad debt, two debtors. Value being 500. And here debtors by bad debt. Is it okay? By bad debt. Value being 500 rupees. And profit and loss account, of course, we may have an extract. Extract means to the extent data available will be posted, not complete P&L account. Here, P&L, 2 PDD. Is it okay? 2 PDD. The value being 1550. And in PDD by P&L account. Okay, by P&L account, 1550. Is it okay? And in PDD, 2 bad debt here. I'm just posting all these things, journal entries in the ledger. That's also 1000 rupees. And finally, bad debt by PDD, right? So by PDD, 1000 rupees. After this, debtors will have a balance of how much? Debtors will have a balance of 9,500. That 9,500 will appear in the balance sheet. That's why I told you here the value available in the balance sheet is 9,500. Is it okay? And then the bad debt account gets closed. 1,000 gets closed. Nothing will appear anymore. In the case of PDD, 1,550 and 400, 1,950 here, 1,950 here. And we have a balance of 950. This is nothing but balance carried out. This will go to the, it's in the credit side, right? Will go to the liability side or can be subtracted from the debtors balance in the asset side. This is also balance. As I already told you, this will also appears in the balance sheet. This will be either subtracted in the debtors in the inner column or can be shown in the liability side. Both will come. And in P&L account, we have this balance. Is it okay? Clear? I hope so you could now understand the ledger. I explained in detail. Now I am going to give the format. First, you have to understand with the journal entry and how it is going to be affecting all this ledger. Later, you can convert that into the format and finish off learning that, right? Come on, copy this and text me once it is over so that I will proceed with the. Listen. Now I am going to give the complete format. First, you have to understand in detail. Thereafter, you can simply remember the format. That's more than enough. Remembering the format will make you work faster. Right? Yeah. Now, so working note number 1. 2 working notes I explained here. Number 1 is debtors. And bad debt, if any, given in the adjustment. Not trial balance, because the bad debt given in the trial balance is already adjusted, right? So bad debt given in the adjustment, it should be subtracted. And you have to create the PDD based on this, provision for doubtful debts based on this. Okay, provision for doubtful debts. Some percentage on this. Usually this will be some percentage on this. Okay, X percentage. This will appear in the balance sheet and this will also appear in the balance sheet. Okay. The debtors will appear in the asset side and PDD will appear in the liability side, or it will be subtracted from the debtors and put the value in the inner means outer column. Right. This is working note number 1. Working note number 2. Where I am going to find out the amount to be debited in the P&L account. This is what about the amount to be shown in the balance sheet. The amount to be transferable to the P&L account is going to be recorded here. The bad debt already available in the TP, because that bad debt somehow is going to be adjusted by debiting to the P&L account if PDD is not there. But already usually we have the PDD, so it is going to be adjusted in the PDD. and bad debt given in the adjustment, both put together, how much I mean need for the next period, which is nothing but the amount calculated here. This one, PDD given in the adjustment, this value, this value. So PDD we have found out in the working note number 1, which is as per the information given in the adjustment, is also be created. So much of amount required, and how much PDD is already available. Already available means the amount available in the trial balance. To that extent is already available. No, you don't need to bother. You subtract that. So balance will be, you have to create. This balance will be debited to the P&L account. Okay, this is going to be debited to the P&L account. Now I'm going to pass a journal entry. How do I pass a journal entry? It's very simple. I have to pass a journal entry for this first of all. For this. The journal entry being bad debt account debit. The bad debt given in the adjustment. Debit to debtors. It reduces the debtors balance. Right? Clear? First part is over. Second part, I have to create the PDD. The PDD creation is this one. Okay? This is the second entry. This is the first entry. This is the second entry. Clear? First one and second one. The second one is nothing but creation of the PDD. The creation is nothing but by debiting the P&L account, I am going to create it. So, profit and loss account debit to PDD. Okay, refer the working note number 2 here. Okay, thereafter finally, the bad debt should be debited to the PDD account. So, I am going to close the bad debt. The closing of the bad debt is nothing but debiting the PDD account and to bad debt. The entire bad debt. The bad debt supposed to be debited in the PDD is nothing but bad debt given in the trial balance as well as the bad debt given in the adjustment. Both put together will be transferable. I hope so you could understand this one. So you have to remember working note number 1, working note number 2, and of course understanding the journal entry will help you to master with the bad debt treatment. If you don't understand that, of course you can solve the illustration without much hiccup. So most of the students will be solving the illustration without understanding and without knowing the journal entry also, but I have given the format of journal entry also. Then now I am going to guide you the ledgers here. I am going to guide you the ledgers. Okay. So what are the ledgers we supposed to prepare? Already I listed, right? An example was already given. So I am going to post those things now. Okay. Wait, I'll just draw the ledger here. Yes. Now, here, bad debt account, balance if any, to balance if any bad debt already appearing, balance. The balance amount is appearing in the trial balance. Okay, that one. Newly created, bad debt to debtors, this is the new one, or the amount we have found out in the adjustment. And this entire value will be debited to the provision for doubtful debts. Is it okay? This is how the bad debt account will appear. We don't have any balances in the bad debt. And we need to now open the PDD account. How the PDD account is there? PDD is a provision or an item of credit balance. The asset is being the credit balance. We start the credit balance here, opening balance, and here to closing balance. Okay, closing balance. To the extent of amount created is debited and created, and this money is used for adjusting the bad debt. So here bad debt. Is it okay? Clear? I'll just mark down all the values. How do we arrive this? Okay. This item, bad debt in trial balance. Okay. I will name this as being A. Is this one, bad debt in trial balance, A. And the new bad debt, this will be here. And then the bad debt transferred to the PDD is the summation of the two. Okay, this will be the C item. And opening balance is nothing but the amount already available in the trial balance. PDD already available in the trial balance. This will be the D. Is it okay? already available here. D balance. Then this is C only. Then final this amount. Okay, 2. The 2 is this one. And closing balance is nothing but this one. Closing balance. I name this being E. The amount appears in the balance sheet hereafter also. Come on, copy all these things. If you have any doubt, you can ask me. I'll discuss one illustration so that this topic will be thorough. You don't have any confusions hereafter if you understand this skeleton. And I'm going to solve the illustration by posting all the information available in this skeleton and make you understand the working experience also, right? Come on, make it faster. Copy this and message me. So yes, the company maintains 10% debtors as provision towards bad debt. The PDD is 10 percentage. It has routed all bad debts through the provision account. So I have explained two models. Here the second model should be followed. The model I have given here, because all the bad debt is routed through PDD. Means you have to create the PDD, only then you can adjust the bad debt. I just gave you the first model where the bad debt is adjusted in the PDD, but the PDD is not sufficient. As the bad debt is pending or insufficient, there is still deficiencies there in the PDD. That amount then later transferred to where in P&L account directly. But as per this statement in question number 4 given here, bad debt should be adjusted through the provision account only. Means if the provision is shortage, you have to create the deficiency first available by debiting the P&L account. So P&L to PDD, and then the PDD is used to adjust the bad debt. That same pattern is given here also. Right? No problem then. The opening balance of the provision on 1/4/2012 was 68,000. This is the opening provision. Opening provision is nothing but the provision available in the PDD. This item, 68,000 rupees. Right. The closing provision on 31st March 2013 was 92,000. The closing provision, the amount you need to maintain at the year end is 92,000 rupees. This one is also given. Okay. Bad debts written off debited to the provision account was 28,000. Okay. Bad debts written off. The entire bad debt here being 28,000 rupees. These are the information given. Now, what's your duty? How much should be debited to the profit and loss account towards provision for doubtful debts for the year ended? Very simple. 28,000 rupees is the bad debt, and then the closing provision required is 92. So rather than giving two bad debt information, one in trial balance and one in adjustments, collectively 28,000 is given, and closing PDD is 92. Sum these two. If you sum these two, this will be 120, and then the PDD already available 68 should be subtracted. This is the subtracting item. So I am subtracting the 68. So the balance being 52 is the amount debited to the P&L account. Very simple. Is it clear? 2-mark question. Such a way you can expect the problem in your examination. Is it clear? The next class I will explain in detail with another illustration where the PDD itself carried with 8 marks and one comprehensive final accounts. With that, I will finish up the